Now, Meenumati wants to know the difference between credit risk funds and corporate bond funds. Which one is safer to park funds intended for SIPs?
Well, it's the credit quality of the underlying portfolio that creates a material difference between corporate bond funds and credit risk funds. So by their investment mandate, corporate bond funds have to invest at least 80% of their assets in bonds of the top quality, bonds rated AAA. While in sharp contrast to that, uh, credit risk funds have to necessarily invest at least 65% of their assets in bonds which are less than top rated. So there is a material difference between the underlying holdings of these funds. And of course, credit risk funds happen to be a higher risk, higher return strategy. Now, what do I mean by credit risk is that these funds invest in bonds of issuers which have a relatively weaker financial standing. And these are the kind of issuers in case of economic downturns, they are more vulnerable to defaulting on their interest payments or principal repayments. And to compensate for that risk, they have to offer a high rate of interest on their bonds. So that's why credit risk funds are better placed to offer better returns. But of course, that comes with a higher risk. Now, coming to the second part of the question around SIPs, well, I would believe that neither of these two categories are an ideal one to set up your SIPs from. For that, I would suggest funds like liquid funds or maybe even ultra short duration funds, which are far safer on all counts, be it credit quality, be it liquidity, be it responsiveness to the ups and downs in the interest rates, the volatility that comes with it. So on all these measures, liquid funds and ultra short duration funds are far safer, and as per me, much better suited categories to set up your SIPs from.